This week we're going to talk about what if you did sell? What if you listened to the concerns, the panic, and just got out of the stock market? So this week we're going to talk about what if you sell, what drives you to sell, why it's so dangerous, and again, what is a better approach to dealing with tough markets. Point number one, process versus feeling. We're going to touch on process in a little bit, but I sum process up this way. A disciplined approach to doing hard things. You can put almost anything into that grinder and spit it out, and that's probably going to be something that's far more process-oriented than feeling-based. Feelings, when it comes to investing, I don't think anybody wants to say they're making an emotionally based decision, but the reality is investing is an emotional practice. We have to account for them. Any plan that's not taking them into account isn't doing their jobs. And again, I want to reiterate to whether you're a client or not, when you call us with questions, with feelings, you will find an empathetic ear on the other side. That we understand is part of our job, but it shouldn't be part of our process. Buffett summed it up saying, people believe the stock market, stock prices are telling them something. He's like, the only thing they tell me is I can buy more for less. They'll take their investings as a personal referendum on themselves. And he's like, it's important to remember the stock market doesn't care about you. So feelings aren't going to help. Most people, again, don't explain it as feelings. What they do look at and what they think is logical is really what amounts to recency bias. Hey, this has been doing really well. Don't you think it'll keep doing really well? Or hey, the market's been really bad. Don't you think it's going to be really bad? I'm obviously summing things up, but that's what it really boils down to. The reality is that's not how markets work. Price action usually surprises you in unexpected ways. Just about the time you think there is a new paradigm that's going to make tech stocks go up forever, the bottom falls out. Conversely, just about the time you think, man, there's no end in sight to this bad news, the market starts to form a bottom. Consider that after a 20% drop, the entering in of a bear market, which we did officially here just a couple weeks ago, here are the average 1, 3, and 5 year returns. 1 year later, a 22% positive gain. 3 years later, a 41% total return gain. 5 years later, a 72% gain. Part of that is certainly about perspective. If you're an investor and have less than even a 1 year time horizon, you didn't have the right plan and or you're not an investor. But again, right at that bear market moment where things are scary and bad, history would suggest the future is actually quite bright. Another history-making stat we just hit here a few weeks ago was back-to-back drops there in mid-June of 5% on the S&P. It's only happened 7 times since the advent of the Great Depression. In 6 of those times, after that just dark drop, again, virtually unprecedented, 6 of the 7 times the market was positive 6 months later and 12 months later. The average 6-month gain, was 20.64%. 1 year later, the average gain 28.16. So again, what has been happening is not indicative of what likely lies ahead. Buffett says it this way, there's nothing about the price action of a stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you believe it will do in the future versus the price you're getting today. Point number 2, when do you get back in? A few points I want to bring out. Again, the stock market is forward-looking. It's going to sniff out the beginning of good news, long before it's going to be making headlines, long before you're going to feel it and or believe it. And I think that's the biggest point that I see time and time again is people get out. The market does still go down for a little while. They really enforce, man, I made the right decision. It's a very hard time to reverse that. To again, buy low means you're buying at a time when no one else really wants to be buying. Very counterintuitive, certainly counter to most of the feelings that we've been having. The other big part is you got out, you got reinforced with that. You're gonna want proof. And we just talked about the markets don't bottom on the beginning of good news. They bottom while the bad news are still mounting. That proof is not going to be there. What's going to happen is the market's likely going to move. It might get past you real quickly, but in any case, you can't afford to miss that many days. Jake touched on this a few weeks ago. If in the last 30 years you just missed the 5 best trading days, it took over a third off your average annual performance. If you missed just the best 15 trading days, not even one every year, one every other year, it took almost 2/3 of your annual performance off the table. That says two things. One, you can't miss the good days and you can't time markets. The other thing it really speaks to is how quickly and violently, in a good way, markets rebound once those bottoms get hit. Summing it up, what is the better place to put your focus? I'm going to talk about 3 things just ever so quickly: process, preserver as in life preserver, and perspective. So from a process, again, a disciplined process is one you follow in spite of how you're feeling. You're going to be selling what's been working to buy what hasn't been working. Nothing inside of you is going to feel like doing that, but that's what proper rebalancing does. Even the ability to do it means you must have been diversified in the first place. Which brings us to point number 2, you need a life preserver. This is your plan in your portfolio. And it comes into, again, those superpowers I've talked about. It could be time. It could be time because you're young and you have many years to still be an investor. It could be time because you're generating enough income. You're not going to be forced to be a seller, whether that's from your job or from your portfolio, i.e. our high income series. It could come form of emergency savings or diversification, as Jake and I talked about in last week's alts video. The third key thing you need to keep your focus on, again, is perspective. Those 3 rings of progress we talk about. Are you constantly increasing your ownership? Are you increasing what that ownership pays you? And then letting the third ring of progress, the value, the account statement, the thing that we all get drawn to, happen over time to allow those historical mean reversions to take root. With that, should you be a seller? Hey, yes, you should. But again, you should be a seller when you don't feel like it, when you're selling those things that have served you well to buy those things that they felt you've been betraying you. That's the path forward to successful investing, and it's one that we're honored to take with so many of you. Thanks so much.